Let's talk inflation, folks. It's a sneaky beast that creeps up on you when you least expect it. What does it mean? Simply put, it's when prices go up over time, making everything more expensive. That fiver you used to buy a week's worth of milk and bread, those days are long gone. Now it barely gets you a loaf and a pint. Prices have skyrocketed. That's inflation eating away at your hard-earned cash bit by bit. Now, how does this affect your investments and savings? Imagine you've stashed £1,000 under the mattress, thinking it's safe. A year later, with inflation at 5%, your money is technically still there, but its value isn't. But guess what? It can only buy you £950 worth of goods now. That's a loss in purchasing power. Your money's lost value. It's like a deflated balloon. This is where investments come in to save the day. You want your money to grow faster than inflation, right? That's the ultimate goal. Stocks, bonds, property, they have the potential to outpace inflation, keeping you ahead of the game and preserving your wealth. But remember, investments come with risks. It's not always a smooth ride. Just like you wouldn't stick all your eggs in one basket, diversify your investments to spread the risk. Spread the risk and aim for long-term growth to beat that pesky inflation and secure your financial future. Now, let's talk mortgages. Ever noticed how those interest rates go up and down like a roller coaster? Well, inflation plays a big part in that ride. Here in the UK, it has just risen sharply by 3%, and it has caused concern among homeowners with mortgages. See, when inflation rises, the Bank of England often raises interest rates to cool things down. Think of it as a way to encourage us to save more and spend less. And what happens when interest rates rise? Yep, you guessed it, mortgage rates often follow suit. But it's not always a simple equation. Other factors like the overall health of the economy, employment rates, and even global events can influence mortgage rates. It's a complex dance, and lenders are constantly adjusting their steps. The great debate, is a mortgage a naughty liability or a shiny asset? It's a question that has puzzled many homeowners and potential buyers alike. Well, it's a bit of both, depending on how you look at it. The perspective you take can significantly influence your financial decisions. In the short term, a mortgage is most definitely a liability. It's a debt that you owe, and it comes with its own set of challenges. You've got a big chunk of debt hanging over your head, and you're shelling out monthly payments like clockwork. This can be stressful and financially draining. Plus, there's always the risk that interest rates could rise, and they often do, pushing those payments even higher. This unpredictability can add to the financial strain. But here's the long game. As you chip away at your mortgage, you're building equity. This is a crucial aspect of home ownership. That's the portion of your home that you actually own. It's like a savings account that grows over time. Over time, as you pay down the loan and property values hopefully increase, your equity grows. This can significantly boost your net worth. This is where the asset part comes in. Your home becomes a valuable financial resource. Think of it like this. You're investing in a tangible asset, bricks and mortar, while also having a roof over your head. It's a dual benefit, not a bad deal, right? So, while a mortgage starts as a liability, it has the potential to become one of your greatest assets. The cost of climbing the property ladder: interest rates. Explained. Let's face it, folks, interest rates can be a real head-scratcher, but understanding them is crucial when it comes to mortgages. In simple terms, interest is the cost of borrowing money. It's the lender's fee for giving you a huge wad of cash to buy that dream home. Now, the interest rate determines how much that fee will be. A lower interest rate means you'll pay less in interest over the life of your loan. A higher interest rate, well, you guessed it, you'll be shelling out more. 25 years on the property ladder, a mortgage repayment breakdown. Let's say you're buying a lovely £250,000 house with a 25-year mortgage at a 5% interest rate. Sounds pretty standard, right? Let's break it down. Over those 25 years, you'll pay roughly £175,000 in interest alone. That's a significant amount of money just for borrowing. That's on top of the original £250,000 loan. So in total, you're looking at paying £425,000. It's a hefty chunk of change, no doubt about it. Many people don't realize how much interest can add up over the years. Now, compare that to investing in a diversified portfolio of funds over the same 25 years. this approach can offer a different financial outcome. Historically, compound interest investments have delivered average annual returns of around 7 to 8%. This means your money could grow significantly. While past performance isn't a guarantee of future returns, it does show the potential of compound growth. The power of compounding can be quite impressive. Plus, those investment gains often outpace inflation, meaning your money is actually growing in real terms. This can help secure your financial future. So both can be great investments over the long term, but the market will certainly fluctuate over time. So it's on you to research what the best option is for your future. Don't forget to drop a like and subscribe for more insight into investments.